So in this section, we're going to talk about expected return and the risk of investments. So normally in news media, when people talk about stock returns, they normally say that this stock has returned 10% over the past year, or it has lost 10% over the past year, right? In other words, they associate a specific number to a stock return. Well, this is possible because that stock return has been realized, so it happened in the past. We have observed that stock return, so we know exactly what it is, right? And these stock returns are called realized returns or historical returns. But when we make investment decisions, what matters most is not the past returns, but rather the future stock returns. And because stocks are risky investments, right? So it's typically not possible to figure out exactly what's going to be the stock return, even for a good investor. Right? So how do we think about a risky investment return? The way we think of this is to associate the stock return with some sort of distribution. The following is an example. Say I'm trying to forecast Apple stock return, right? Instead of saying that the stock return of Apple over the next year will definitely be 15% or something like that, we don't do that. Instead, we say that, well, Apple stock return over the next year will follow such a distribution. So I have three different scenarios in this distribution, right? A good scenario, a normal scenario, and a bad scenario. If it turns out to be good, then Apple stock return will be 20%. Under the normal scenario, Apple stock return will be 5%. Under the bad scenario, Apple stock return will be negative 15%. But I don't know exactly which scenario will occur over the next year. But I do know that they occur with different probabilities. So there's a 30% chance that we will see the good scenario. There's a 50% chance we will see the normal scenario. And there's a 20% chance we will see the bad scenario. Okay? So in this case, you can see that we know that Apple stock return is risky because we're not sure which scenario will occur. We only know the possibilities. Right? So we accommodate that uncertainty using this approach. Just to summarize, when we use a distribution to represent a forecast, we have some key elements here, right? So the first is we need a list of scenarios. So in this example, I used 3 scenarios. Of course, in reality, you probably need more scenarios than 3. Okay, but here is just a simple example. And also, we need to know the stock return under each scenario. So in this case, it's 25 and a negative 15. Finally, we need to know the probability of each scenario, right? So here is 30%, 50%, and 20%. Keep in mind that if you sum up the probabilities of all the scenarios that you consider, these probabilities must sum up to 1. Okay, so if you consider all the possibilities, then you sum up the probabilities, they must sum up to 1. So that's important to keep in mind. Another important thing to keep in mind is that because we all come up with these distributions based on our understanding about the business of the company or about the economic condition going forward. So all these forecasts are highly subjective. Different analysts, different investors will come up with different forecasts. Okay, so there's no unique forecast for a stock. So this kind of a scenario chart is one way to describe our forecast. An equivalent way to do this is to use this histogram, right? So this chart and this chart are equivalent. So let's see how they're equivalent. So in this chart on the right-hand side, we have 3 bars. Each bar represents a scenario. So here, this yellow bar represents the good scenario. The blue bar represents the normal scenario. The green one represents the bad scenario. Okay. And you can see that these bars have different heights, right? The height of the bar represents the chance for that scenario to occur, or the probability for that scenario to occur. So here the blue bar is the highest, so that means the most likely scenario here in our forecast is the normal scenario, right? And these two, good and bad, are less likely, so they are shorter. Also, the location of the bar along this horizontal axis. Okay, so you can see the yellow bar is at 20%, the blue bar is at 5%, the green one is at negative 15%. So the horizontal location of this bar represents the return under each scenario. Right? So under normal scenario, we obtain 5% return. Under a good scenario, we obtain 20% return, and then this negative 15% under bad scenario. So it's actually more common in economic analysis to use this kind of histogram to represent a forecast. Okay. So once we have the distribution or the forecast of future stock returns, the next concept to learn is the expected return. Okay. So sometimes, actually very often, we use this ER to denote expected return. So E is for expectation, R is for return. Okay. So what is the expected return? Well, roughly speaking, if you look at this representation of the forecast, right? So this is a typical representation of the forecast in the sense that normally we have this highly likely scenarios in the middle, so they tend to have higher bars because they're more likely. And then as we move away from the center, the results become less and less likely, so the bars become shorter and shorter, right? So typically, as you go away from the middle, the bars get shorter. So which means a very good case is not very likely, nor is a very bad case, right? So this sort of middle cases are more likely. So when we have a distribution like this, sort of the center location of the distribution is close to the expected return. So in this case, the expected return of Apple should be close to 5%. Okay. So how do we calculate? I mean, it's close to 5%, but it's not exactly 5%. So how do we calculate the exact expected return of Apple according to our forecast here? Well, the formula for expected return looks like this. So it seems like this is a long formula, but let's break it down and see why the formula looks like this. Right? So our formula for the expected return has three terms. So this term plus this term plus this term. So each term is corresponding to a scenario. Okay. So the first term is corresponding to the first scenario. 20% here is the return under that scenario. 30% is the probability of that scenario, right? So in other words, the first term is equal to the return under the scenario multiplied by the chance of that scenario. And this is the same thing for the rest two terms. Return of that scenario multiplied by the chance of that scenario. So in other words, this formula for the expected return is a weighted sum of the returns under each scenario. They are weighted by the chance of those scenarios. So if a scenario is very likely to occur, then that return plays a more important role in the expected return. Right? So in other words, the expected return is going to be fairly close to those highly likely scenarios. So if you carry out the calculation here, the expected return of Apple according to our forecast is going to be 5.5%. So it's important to understand that the expected return tells us what we should expect to earn on average, right? But of course, in reality, the next year, the actual return of Apple could be better or worse than the expectation. Right? In fact, the return is rarely equal to the actual return is rarely equal to the expectation. Right? So this shouldn't be surprising. For example, let's think about this statement, right? We say that on average, each American family has 2.6 children. What does that mean? It just means that the average number of children in American families is 2.6, right? So it doesn't mean that any family will actually have 2.6 kids, right? That's just absurd. So it's the same idea with expected return. Actually, most likely you won't see that expected return. It just tells you that that's sort of the center of the distribution, and we're equally likely to do better or worse than that center. Okay. Okay. So expected return tells us basically what's going to happen under a normal condition, right? But of course, we know that there's always risk involved in investments. So we need to understand those risks, and we need to quantify those risks. Right? And because risk is such an important topic in finance, so people have devised many different measures of financial risk. So as a starting point, we're going to focus on the concept of volatility. Okay, this is also the standard deviation of returns. And we normally use the Greek letter sigma to represent volatility. So because the formula for calculating volatility is relatively long, so I'm not going to ask you to remember that formula, okay? But I do need you to understand the basic intuition behind volatility. Okay. So without doing any calculation, let's compare the volatility of Apple and the Tesla according to my forecast here. Okay. So remember, for each forecast, we have two ways to represent that forecast. One is to use this chart here. The other is to use the histogram. Okay, so they have the same information. So this is the forecast of Apple return. This is the forecast of Tesla return. So let's think about which stock has a higher volatility, even without doing the calculation. Most of the investments we're going to be dealing with are risky in the sense that we're not sure what's going to be the return of that investment in the future. Right? We can have a distribution, we can have a forecast, but we do not know the exact number. A special case here, an exception, is the US Treasury bills, or T-bills. Okay. And these T-bills are often considered risk-free. So basically, T-bills are short-term debts issued by the US government, because we normally assume that the US government will not default on their debt, so these bills are risk-free. Okay. Because they're risk-free, so the volatility for these T-bills are zero, because there's no uncertainty. We often use this notation RF to represent the rate on T-bills. I guess when you go to the bank to buy a CD, a one-year CD, that's basically risk-free. So normally the CD rates are very similar to the risk-free rates. Right? So next time when you think about the risk-free rate, just think about the CD. So now we understand the expected return and the risk of financial assets. Right? So an important concept based on expected return and risk is the Sharpe ratio of a financial asset. Specifically, the Sharpe ratio of an asset is equal to the expected return of that asset minus the risk-free rate divided by the risk of that asset. And because the numerator here is the expected return, so when we make investments, we want to earn more expected return. So that's the reward of our investment, right? And the denominator here is the risk of that investment. When we make investment, we must be careful about risk. We should try to avoid risk. We don't like risk. So that's the risk of the investment. Therefore, this ratio is actually the reward of the investment divided by the risk of the investment. Therefore, this is also known as a reward to risk ratio. In this definition, the numerator itself is also a very important concept. For a risky investment, the expected return of that investment minus the risk-free rate is known as the risk premium of that investment. Why is it called a risk premium? Intuitively, when you make a risky investment, okay, so the only reason you're willing to take that risk is because you expect to earn some extra return, right? Because otherwise, if you don't earn that extra return, you would rather invest in the risk-free asset. Okay, think about this. Therefore, the expected return minus the risk-free rate represents the reward for taking that extra risk. So this difference, the numerator itself, is known as the risk premium of that asset. You can calculate the risk premium and the Sharpe ratio for any risky asset. It could be a stock, it could be a bonds. Just make sure that these, if you calculate, for example, the risk premium of Apple, right? So this is going to be the expected return of Apple, and this is going to be the risk of Apple stock, right? But the risk-free rate, because this is the T-bill rate, so this value does not change with the risky asset. Whether you're doing the risk premium for Apple or for Google or for Tesla, the risk-free rate is the same because this is the government bond rate. Okay, so this does not depend on the stock. A special case here is when the risky asset we're considering is the market portfolio, meaning if you hold the entire stock market, the US stock market. Okay, so if you're holding the market portfolio, then the expected return of the market portfolio minus the T-bill rate is known as the market risk premium. Okay, so this is an important concept in finance.